Academy. Today we are going to discuss and understand the impact of long-term capital gain tax in equities introduced by Finance Minister in his first Feb 2018 budget speech. Finance Minister Arun Jaitley introduced the much talked about long-term capital gain tax, that is LTCG, on sale of listed securities on gains of over rupees 1 lakh. He introduced a long-term capital gain tax of 10% if the gain exceeds rupees 1 lakh without allowing the benefit of indexation. However, all gains till 31st Jan 2018 will be grandfathered and short-term capital gain remains unchanged at 15%. So let me explain all these jargons now. Before this budget speech, there was no tax on gains or profits you got after selling shares or equity oriented mutual funds after 1 year. This gain you get after 1 year is called long-term capital gain or LTCG. So last financial year, investors gained long-term capital gains of rupees 3,67,000 crores in shares or equity mutual funds, and government didn't earn a rupee of tax. So they have planned to sort this out now by introducing this LTCG tax on your long-term gains. So from next financial year onwards, that is from 1st April 2018, these gains will be taxed by 10%. Now here are the things to note. If you have long-term gains profits before 31st Jan 2018, then you don't have to pay taxes on those gains. For this, Finance Minister has used the term gains before 31st Jan 2018 are grandfathered. So this tax is not retrospective, which is a very good thing. So you only have to pay tax on gains you earn from 1st Feb 2018 onwards. Even on these gains, government has said no need to pay tax on first 1 lakh rupee of gains. So all small investors need not worry and mostly will be out of this impact. Another important point to note here is all other taxes like short-term capital gains or security transaction tax will remain as is and there is no impact on them. So they will coexist and this LTCG tax will be an additional tax on equities. Now this 10% LTCG tax is without indexation benefit. So you don't get any tax benefit because of inflation and you cannot do any inflation adjustments like you do in long-term capital gains of debt funds or other debt instruments. So it will be a flat 10% tax over rupees 1 lakh long-term gain from 1st April onwards. Now here are two dates which we are talking about, 31st Jan 2018 and 1st April 2018, which is causing some confusion, and let me explain that. So if you sell your equity assets before 1st April 2018 and if you have hold them for more than 1 year and whatever gains you got, there is still no capital gains on them. So it will be treated as before the budget speech because this is 2018-2019 financial year budget proposal, which is not applicable on current financial year, which is 2017-2018. Now, if you sell your equity assets on or after 1st April 2018, then your gains will be calculated from 31st Jan onwards and you will need to pay tax only on those gains which you have got from 31st Jan, as all the gains before them are grandfathered as we have discussed above. Hope you understand the relevance of these two dates. We will explain all this with 5 different examples in just a bit. Now this table has a good summary of what we have discussed till now. So what assets are included in this? All your shares or stocks listed on stock exchange, equity mutual funds, ELSS funds, balanced funds, equity savings funds, arbitrage funds. So gains on all these assets will be included in this new LTCG tax purview. Though it is not clear in the budget document, but in all likelihood, equity oriented ULIPs are kept out of this tax purview. Anyways, ULIPs have 5-year lock-in and inefficient fund management charges, so they will still remain unattractive, though the gap has little reduced now. Before we discuss various examples, let's first see how to calculate the cost of acquisition for this new tax purposes, which will determine how much tax you pay in future. This is what government notification says. Cost of acquisition of the share or mutual fund unit bought before 1st Feb 2018 will be higher of A or B. A is actual cost of acquisition of the asset, that is from the purchase price perspective, and B is the lower of highest price of share on stock exchange on 31st Jan 2018 or NAV of unit of mutual fund on that day, and the sale value received when the share or unit is sold. So lower of these two. Now let's discuss 5 different scenarios with examples. The first is, as we have already discussed, if the equity asset is sold before 1st April 2018, there will be no long-term capital gain tax liability as shown in the example here. So no difference in tax value before or after the budget in this case. Now second scenario. This scenario is important as it shows what happens when asset is sold after 1st April 2018. We know the purchase price, sale price and value on 31st Jan 2018 of our asset. Now we need to calculate the cost of acquisition as per this notification we discussed. So here first we need to see the lower of these two and then higher of these two. So here 130 will be the cost of acquisition based on this. So now long-term capital gain will be total sale value minus total cost of acquisition based on this price, and we get this value. Now we need to deduct rupees 1 lakh exemption from this. So long-term capital gain tax will be 10% of rest, which is rupees 10,000 in this example. Now in third scenario, sale price has decreased compared to its value on 31st Jan 2018. So lower of these two now becomes this, and higher of these two is rupees 130. So here sale price is price of acquisition and therefore capital gain is 0 and hence low long-term capital gain tax. Now the fourth scenario, value on 31st Jan 2018 was less than purchase price, but it increased when we sold the asset. So cost of acquisition is lower of this and then higher of this, which is rupees 100. So purchase price becomes cost of acquisition in this scenario, and based on calculations, long-term capital gain before budget and after budget is same, but now tax has come, which will be rupees 20,000 in this scenario. Now last scenario is if purchase price is after the budget announcement and not before, as in other 4 scenarios. So market value of 31st Jan becomes non-relevant here. So purchase price will be cost of acquisition in this case, and we calculate long-term gains normally as we do. So the total tax on that will be 10% of 3 lakhs minus 1 lakh, which is 2 lakhs 10%, and here comes 20,000 rupees tax on this scenario as well. Now hope you understood how this tax works. Now let's understand the impact. First, the tax was expected. All major economies have tax on equity capital gains. Check the table below. Secondly, it does directly impact your equity returns. So from now on, if you were expecting 12% returns on your equity investments for long term, you need to reduce them by 1.2%. So new expectation from equity should be 10.8%. Third is difference between ULIPs and ELSS funds has reduced a little, but according to us, ELSS still scores because of lower lock-in, lower cost of management, and much more transparency and easier to understand. Fourth is to make parity between growth and dividend option. Government has also introduced 10% dividend distribution tax on dividends given to you by equity funds. So you can't escape LTCG by opting for dividend plan. This tax on dividend or DDT was not there before. All the dividends on equity oriented funds was zero before this budget speech. So what you should do, what should be your next step? First is, if your goal is near and you are planning to sell your equity funds or stocks in next few months, then you can sell it before 31st March without facing any tax on gains. Secondly, if you are a small investor and your gains may not go beyond rupees 1 lakh in near future, you don't need to worry about this tax at all. Third is, if you are a new and young investor and have started investing recently, then you need to get accustomed to this new status quo on taxation. Get your returns expectations changed and then make changes in your goals accordingly. Fourth is, attraction of equity savings funds and arbitrage funds do get negatively impacted due to this tax. But still, this taxation scores over debt version, and hence these categories will still survive. Please remember, equity is still the best asset class for our long-term goals, and this taxation doesn't